stocks rising right now as boosted by strong earnings and some tech optimism. Joining me now, we've got Liz Miller, who's the Summit Place Financial Advisors founder and president. Liz, good to have you on the program with us. You say investors should feel comfortable getting into this market. Why is that?
Well, we know there was a lot of cash on the sidelines all throughout last year from investors who sort of felt like they missed it and kept saying, is now too late, is now too late. And then there was a lot of profit taking into year end. So we know there's a lot of cash on the sidelines. And when we get days like today, this great strong day, a lot of investors again will say to themselves, well, let me wait, maybe I missed it. But, one of the big things we're seeing it today and really over the last day or two is that, the market that was a little bit sideways the beginning of this year with uncertainty is now breaking out. It's moving higher. And all those underlying trends in our economy that we knew were good for the market, earnings coming, a decent employment outlook, are starting to come through, and we little by little will get rid of that uncertainty of what policy looks like this year.
And it's policy two-pronged, right? Because it's policy that's coming from 1600 Pennsylvania Avenue as well as from Capitol Hill, and that policy aimed at what Trump and President Trump and his administration will target in terms of tariffs. And then the other side of that policy is, okay, if tariffs do get implemented and there is some type of pass-through to inflation, how does that impact Fed policy here? How are you striking a balance, especially as you're charting forward your own portfolio strategy?
What we've done for the most part is continually balance those two policy uncertainties, as you said, the Fed versus fiscal policy and potential tariffs coming out of Washington. But one thing we all know, it's nice to have a president who we know a little bit about, and we understand as investors that the right step is to wait and see the actual policy. And you see that in the long term in the markets, that in the short term, we do see that volatility when comments are made and they suggest much higher tariffs and inflation that can come down the pike. But if we stick to a discipline of understanding the underlying U.S. trends are good domestic growth, good earnings growth, and reasonable capitalization of companies, we found last time and we'll probably find this time around, that will come through in the markets because the discussion looks a lot scarier than the policies that end up really taking hold.
Let's focus in on the Fed a little bit more here as well. When you think about the amount of rate cuts and what that would also need to sense and really kind of say about the economy more broadly, if we did get to that point later on this year, it seems like it's not until later on this year that we will see, and in the back half of this year, that we might see any type of rate cut coming from the Fed. What's your anticipation there?
We do expect to see some rate cut this year, but clearly a lot of uncertainty. And what we're seeing in the bond market, the fact that longer maturities have moved higher is those experienced bond investors getting ahead of the Fed. They're really telling the rest of us what they expect out there. There's a real feeling that the Fed doesn't have much strength right now. It's almost like we kind of talk about a lame duck Congress. It's almost a lame duck Fed for the next year. And so we're going to look a whole lot more at what the bond market tells us about concerns. And really, the 10-year is a little over 4%. And if you look at long-term history, that's not that high. We've just spent the last 5 to 7 years used to these unusually low rates. But a 3% inflation environment, a 4+% 10-year yield is very average for long-term history and has never put the brakes on an economy.
Liz, just lastly, while we have you here, I want to get some actionable picks right now that you're targeting, especially even as we began the conversation saying that this is still a safe market to get into. Where are the top areas that you're prioritizing?
We're prioritizing investments that have a strong domestic exposure because of that global uncertainty. Over 40% of revenues in the S&P 500 come from overseas. So one of the first things we've been talking about that was spoken about on the last show is small caps. We do like the exchange traded fund for the Russell 2000. We look at the IWM. Small caps are at very reasonable valuations. They've lagged. And when we see a stable environment and ongoing growth, they have a lot of potential for upside, and they tend to be very domestically focused, most of the companies there. So we think if you're a mutual fund or index investor, this is a great choice right now. We also like the REIT area, which is also lagged behind and is very US domestically focused. One of the leaders there being equity residential. The United States is still very underbuilt for residential housing, and EQR is one of the leaders in that segment of the real estate market.
Liz, thanks so much for taking the time here with us this morning. Appreciate it.
Great to see you.